This is a good one. Let's talk about closing cost payment methods. And so I'm saying the word methods because who pays for these closing costs? We'll talk about that too. That's slightly different. But let's talk about the closing cost payment methods, like how this may show up for you, whether you're buying a home or refinancing, it doesn't matter. There are essentially four different ways or four different methods to pay for closing costs. The first and most obvious is cash. You can write a check for these things at closing. That's part of just the closing cost. You pay for them at closing, fine. Number two can be you roll them into your loan amount. This may not always be an option, but certainly it can be. So if you're buying a home, it would be in the form of like a seller concession. That's where you kind of roll it into loan. So seller concessions, I shouldn't use air quotes for that. That's how you quote roll it in on a purchase. So when you buy a home, the seller can pay for those things, and that's ultimately one way to roll it in on a purchase. On a refinance, you just take a higher loan amount. So if you were getting a loan amount of 400,000 and there's $4,000 of cost, you now can get a new loan amount of 404. Now, with a refinance, there are restrictions as far as loan to value. Do you qualify? All those details, but that's a method. Is how you can roll those closing costs into the loan balance. The third way is you can increase your interest rate and have the interest rate pay for it. That would show up in the form of a lender credit. So this can be done both on purchase and refinance. And so by taking a higher interest rate, you're agreeing, obviously, you're going to pay more interest because of that. You're agreeing that for the trade-off, you'll get some lender credit at closing. We will talk about why and when you should do that, but that actually is a really good idea in some markets. So let's talk about when in just a second. And then lastly, number four, technically number four is just a combination of what I just mentioned. It's 1 through 3. Maybe you pay a few bucks in cash of closing costs at closing. Maybe you roll some into the loan amount and or have the interest rate pay for some as well. So you can do a combination of all those things, but ultimately that's it, right? You can either write a check for it, roll it into your loan amount, roll it into your interest rate, or some combination thereof. Those are the four ways, the four methods of paying for closing costs. Now let's talk about when you should do each. And then who can pay for those things. So first and foremost, let's make something very clear. When somebody says they have a no closing cost or a low closing cost loan, at the end of the day, they're not choosing to do a loan for free. They're not, no lender is going to say they're going to make profit doing loans for free, obviously. So there's, the no closing costs it's just, it may not be in the form of you writing a check at closing. It may be in the interest rate. In terms of low closing costs, again, it's just restructuring it differently. It's a marketing game, and I'm not saying game, but it is, right? Especially some of the really big box ones, big box companies, man, they are really good at the marketing game for sure. But it's all going to be the same. At the end of the day, people need to get paid. Loan officers need to get paid. Underwriters need to get paid. Closers, funders, the company, like these people will get paid regardless of whether you write a check at closing or you pay for it in a different way. So those are the closing cost methods. So let's talk about which one you should do and when. So paying cash, if you're just flush with money and you want to write a check and pay cash, absolutely more power to you. You certainly can. If you got a ton of money in the bank and it's burning a hole in your pocket and there's nothing else you'd rather do with it, and there are those instances, and absolutely that makes a lot of sense. So absolutely do that. Rolling cost into the loan amount. So this may be for like purchases. If somebody's already paying a lot of money for a down payment, maybe they're stretching to get to whether it's 5% or 10% or 15 or 20 or whatever percent, it doesn't matter. If somebody's just saying, okay, my dollars I'm willing to part with today at closing, right? These dollars, the comfortable amount that I want to part with, and maybe whether that's all they can or want to do, it doesn't matter. But if that's all that they have going forward, seller concessions is just a way for the seller to pay those closing costs on behalf of the buyer. Or rolling into your loan amount means that you don't need to come up with that extra money. So let's take a purchase. If somebody says, hey, I'm going to buy this house for 500 grand and I'm going to put down 20%. So now they're going to put down 100 grand. So it's $400,000 loan amount. You can do this and they go to the lender and the lender says, hey, your closing costs, are going to be $4,000 or whatever the number is going to be. Well, they can go back to the seller and just say, hey, bub, do you mind? I'll buy your house for 504. And will you in then turn pay $4,000 in closing costs on my behalf? The seller shouldn't care. It's the same net to them either way. But that way you still got that 20% down payment that you can use to make sure that you avoid a mine if that is the goal and the objective. On a refinance, you just may say, hey, I want to keep my money in my bank and roll it in. If you have the equity and ability to do that and it works, more power to you. Let's talk about increasing the interest rate. Number 3, right? I talked about earlier, there's a time and place for this. The time and place typically is when a market is where rates are elevated and we think, we being, the home buyer and us, right? We all believe and think that rates can and will eventually come down in the semi-near future, whether that's 1 year or 3 years, could be even 5. But if you think somewhere in the next 1 to 3 years, 1 to 5 years, rates are coming down and there's a possibility you'll be refinancing again, then that is a great opportunity to roll it into the rate to where you take an artificially higher rate, meaning a rate higher on purpose, to then use that money to pay for your closing costs. Because like right now, if you were to take a scenario where somebody says, hey, the rates are 7%, and to do a loan to buy a home, and if you think a year from now, maybe even 2 years, rates are going to be back down in the mid 5s or 6s, you're most likely going to refinance that loan. So not even have it. So who cares if you coulda, woulda, shoulda had a 6.75 versus a 7%? Because if you save a ton of money at closing and it makes sense where you refinance later, then that's the idea in the scenario where it makes sense. And maybe even if rates aren't high, if you just say, okay, my credit's not great, and I'm going to end up wanting to move, or a kid's going to college, or I'm going to take cash out later on for a pool or whatever it may be. As long as you think a refinance is coming and you're getting rid of this loan, a higher rate on purpose can make sense if it covers the closing costs. It's just a matter of running the numbers to see where the break even is. It says, hey, I'm about to save, making the number up, $2,000 in cost. And so now if I'm going to save, pay $100 more per month, well, we know that it's going to take 20 months or a little over a year and a half before you get hurt for having that higher rate. So if we think we're refinancing the next 6 or 12 months, then absolutely take the higher rate. And then last is a combination. That's just, for maybe there's a little bit of each one of those scenarios of why it makes sense and what you do. That's what the combination's for. So at the end of the day, that's the methods. But again, who pays for it? Whether it's seller credit, whether it's the lender credit because you took a higher rate, whether your realtor wants to give you some money, whether it's a gift, mom or dad, maybe giving you money or whatever it may be. Maybe the seller, if there's a gift of equity, if you're buying it from your uncle or something, you can pay for things that way too. But those are all ways to pay for it. But the 4 methods we just talked about, again, there's no right, like all the time, every time, there's no fundamental blanket answer, but that at least gives you an idea. Certainly the Mortgage Mark team will walk you through any and all your questions that you have. Reach out to us. And as always, when you think mortgage, think Martin.